Welcome to the Deep Dive, powered by Talk Tickers. Today, we are digging into the Q2 2025 results for TripAdvisor, ticker TRIP. They reported after the close on August 7th.
And if you glanced at the stock the next day, you saw the reaction. Big jump, up nearly 12%.
Right, so our mission today is pretty clear. Figure out why. Why did the market rally like that? We need to unpack the whole portfolio mix story, get a handle on which segments are really driving profitability now, and, talk about that activist situation looming over everything.
Okay, let's get into it, because you're right. The revenue itself wasn't exactly a blowout. It was more about the quality of the earnings, as they say.
Exactly. So what were the key numbers that got investors excited? Lay out the basic financial picture for us.
Well, the main thing really was that the market looked past the top line and zeroed right in on margins, and the bottom line beat. Non-GAAP EPS came in at $0.46.
46 cents. And consensus was what? $0.41 to 43 cents. So solid beat there.
A very solid beat, yeah. Meanwhile, total revenue was $529 million. That's 7% growth year over year, 5% on constant currency. So like you said, pretty much in line with what people expected. Maybe a hair light for some.
So the pop wasn't about revenue growth then?
Nope, it was about adjusted EBITDA. That hit $107 million, which translates to a really strong 20% margin. That definitely beat expectations.
Okay, a 20% adjusted EBITDA margin. That's the number.
That's the number. The market reaction was basically a sentiment check. Investors are saying, okay, we see the leverage, we like the profitability shift. They rewarded that quality.
And this ties into the narrative management's been pushing, right? This whole portfolio transformation.
Exactly. They kept emphasizing that the bulk of the revenue, now, what is it, almost 60% over the last year, and certainly the main profit drivers are shifting to those growth areas, Viator and TheFork.
So it's like the company's center of gravity is actually moving away from the old search model towards these marketplaces.
That's a good way to put it. It's really happening.
All right, let's break down those marketplaces. Start with Viator, the experiences platform. That's really the core growth engine, isn't it?
It absolutely is. So Viator revenue was up 11% year over year, landing at $270 million. But interestingly, the actual volume, the number of experiences booked, grew faster, up 15%.
Okay, 15% volume growth.
Yeah.
That shows healthy demand. But what about the profit side? That's been the question mark for Viator historically.
Right, and that's where the breakthrough is. Adjusted EBITDA for Viator hit $32 million. That's a 12% margin for the segment.
12% margin on Viator. Wow, that's a big jump from where they were.
Huge jump. It's nearly an 800 basis point improvement compared to last year. So almost 8 full percentage points higher margin.
Okay, 800 basis points. How? What drove that massive improvement without hurting the volume growth?
They highlighted two things mainly. One, much more efficient marketing spend. They're getting smarter there. And two, really strong repeat business from their app users. Those users are apparently quite valuable and drive leverage.
So the app strategy is paying off in terms of repeat high-value customers.
Seems like it. It gives them confidence in the long-term margin potential as it scales.
Got it. But there was a slight caution flag on Viator for Q3, wasn't there? They guided revenue growth to slow down a bit.
Yeah, they guided Q3 Viator revenue growth to high single digits. But it's important to understand why. They said it's a mix issue.
Mix issue, meaning?
Meaning a higher proportion of bookings are coming from third-party merchants, they're 3P partners. These bookings often have a lower average value and, crucially, a lower take rate for TripAdvisor.
Ah, okay. So it's not that demand is falling off a cliff. It's just the type of bookings temporarily dilutes the overall revenue growth rate compared to that strong volume growth.
Exactly. They were clear it's still incremental, profitable volume, and they expect growth to pick back up in Q4 based on booking trends they're seeing.
Okay, that makes sense. So Viator is showing efficiency gains. What about the other growth engine, TheFork? That's the European dining business. Similar story there.
Even more pronounced, actually. TheFork saw revenue growth accelerate up 28% year over year to $54 million.
28% growth, nice acceleration. And the margins.
Even better. Adjusted EBITDA was $9 million, which works out to a 16% margin.
16% margin on TheFork. Wait a minute. If you look year over year, that margin has more than doubled, hasn't it?
It has. It's up 900 basis points, 9 full percentage points higher than last year. Really significant operating leverage kicking in.
Wow. So how are they achieving that kind of leap at TheFork?
Well, they mentioned strong growth in their B2B subscriptions, basically. More restaurants signing up for the premium tiers, paying them more, and also getting momentum from partnerships.
Right, the partnerships. They mentioned Vodafone.
Yeah, the Vodafone partnership is ramping up, and they also talked about a new exclusive deal with Mastercard for dining experiences across Europe. They think that one will really start contributing in the second half of the year.
Okay, so two strong growth stories with improving margins in Viator and TheFork. But we can't ignore the original business, Brand TripAdvisor. Still the cash cow, but facing headwinds.
Definitely still the cash cow, but yeah, the headwinds are real. Brand TripAdvisor revenue was actually down 3% year over year to $242 million.
Down 3%. And that's mostly the free traffic problem they keep talking about.
That's the main driver, yeah. Persistent pressure on those legacy free traffic channels. But even with that decline, the segment still threw off $66 million in adjusted EBITDA.
$66 million. So the margin there is still, what, 27%?
Exactly. Still incredibly profitable. It's funding a lot of the investment elsewhere.
And management strategy to fight the decline is shifting focus, right? More paid channels, focusing on app users and members. Is that actually moving the needle?
Well, the data they shared suggests it is, at least with the most valuable users. They said app users are their fastest growing audience segment. And importantly, the average revenue per user, the ARPU for those app users, is growing double digits year over year.
Okay, so even if the total free audience shrinks, they're getting more value from the direct, engaged users. That's the pivot.
That seems to be the plan, and it looks like it's starting to work on that specific cohort.
Let's shift gears to the bigger picture, the strategic stuff. Management spent a lot of time talking about operational coordination between Viator and Brand TripAdvisor.
They did, leveraging assets across product, supply, marketing, especially trying to boost experiences by using the whole group's resources.
Okay, but let's be honest. Does operational coordination just sound like corporate speak for, please don't make us break up the company? Especially with Starboard now involved.
Well, you have to wonder, right? It certainly feels like a defense mechanism. They did cite some early tests showing benefits when they optimized marketing across both brands together, trying to prove that 1 + 1 = more than 2. But the timing with the activist pressure is convenient.
And of course, AI was everywhere in the commentary. Was it just buzzwords, or are they actually using it in meaningful ways?
It seems pretty embedded, actually, not just buzzwords. They talked about using it for better search and discovery on Brand TA, refining search results on Viator, even testing conversational AI for restaurant recommendations on TheFork.
Okay, so practical applications. And how do they see themselves playing in the bigger AI search world with ChatGPT and everything?
They're positioning themselves as a critical partner, basically saying, hey, we have all this unique content and data. You generative AI models need us. And they think their experience in optimizing content gives them an edge there. Plus, using AI internally for things like content moderation to boost efficiency.
Makes sense. Let's talk cash flow. Q2 looked pretty good, $177 million in free cash flow.
Yeah, the cash flow picture looked much cleaner this quarter. But it's important context that the big year-over-year jump was mostly because last year, Q2 had that huge outflow for the IRS settlement.
Ah, right, the transfer pricing thing. So it's more of a cleaner comparison this year without that big one-off payment?
Exactly. No huge drains this time around. And they kept buying back stock, too, about $40 million worth in the quarter.
Okay, so capital return continues. What about the outlook? Did all these moving parts, the Brand TA softness, the Viator mix, cause them to lower guidance for the full year?
Surprisingly, no. They reaffirmed the full year 2025 guidance for consolidated revenue growth, still 5.7%. And for Q3, they're expecting 4.6% growth.
So they're standing by the outlook, even with those known pressures.
Yeah. They basically said the guidance already factored in the Brand TA headwinds and the Viator mix shift. It suggests they feel the leverage and the strength in the growth segments can offset those issues for the full year.
All right, now the elephant in the room. Starboard value. Over 9% stake disclosed just before the call. That changes everything, doesn't it?
It absolutely hangs over everything now. When analysts asked, management gave the standard line, we value constructive engagement with all shareholders.
Translation. Can't really talk about it.
Pretty much. But yeah, that activist angle is now the biggest potential catalyst. It could force big changes in strategy, structure, capital allocation. Everything's potentially on the table.
And just quickly on the macro environment. They seem to feel okay about consumer spending, right?
Yeah.
Validating the focus on experiences.
Yeah, they echoed the theme of consumer resilience, especially in travel and experiences, which obviously helps their core growth areas. But There was that moment when analysts pushed them on when Brand TripAdvisor might actually stabilize. Remember, they used to hint at 2026.
Right. What did they say this time?
They backed off that a bit, said it was too early to call 2026, acknowledging those free traffic headwinds are still pretty persistent.
So less certainty on the Brand TA turnaround timeline.
Yeah.
Which, again, probably just gives Starboard more leverage, doesn't it?
You'd think so. It adds to the pressure to find other ways to unlock value if the core brand turnaround is looking tougher or further out.
Okay, now let's transition to our final segment. This is the part of the deep dive that is absolutely not financial advice. We take everything we've heard and pitch an outrageous but plausible trade idea. What have you got for Trip?
All right, today's thesis is pretty straightforward, actually. It's long trend equity, but the focus is almost entirely on the governance catalyst.
Meaning betting on Starboard forcing change.
Exactly. Look, the market is finally recognizing and rewarding the better unit economics we're seeing in Viator and TheFork. That's clear from the reaction. But there's still arguably a big valuation gap between what those growth assets could be worth on their own versus where the consolidated company trades, especially with an activist like Starboard now involved.
So what's the outrageous but plausible path to unlocking that value?
The pitch is this. Brand TripAdvisor, despite its headwinds, is still a cash machine, right? 27% margin. The trade is essentially a bet that Starboard's pressure forces management's hand within, say, the next 12 to 18 months.
Of course, their hand to do what?
To spin off or sell Viator. Separate it completely. If Viator gets valued as a pure play, high growth experiences leader, which the market might assign a much higher multiple to than what's left, the Brand TA stub would likely look incredibly cheap. It's still free cash flow positive, has valuable IP.
So the sum of the parts value is significantly higher than the current combined value, and Starboard is the catalyst to realize it.
That's the bet. Starboard pushes for the separation that management's coordination strategy seems designed to avoid, and current shareholders get rewarded as that value gap closes. It's the classic activist playbook applied to what looks like a pretty compelling financial restructuring case.
A very clear, catalyst-driven thesis there. Focused squarely on breaking up the company to unlock value.
It bypasses the question of whether management's current strategy will work long-term and just focuses on the potential value unlocked from separation.
Okay, that was a great deep dive into TripAdvisor's Q2. We hit the earnings beat quality, the whole operational coordination plan versus activist pressure, the really impressive margin improvements at TheFork, and Viator's continued growth despite some mix shifts.
So the final provocative thought for you, the listener, is this. Management is betting heavily on this operational coordination using AI, sharing assets between Brand TA and Viator. But will that synergy really be enough to satisfy an activist like Starboard, who likely sees a cleaner, potentially more valuable path through separation?
You'll definitely want to keep a close eye on those Q3 and Q4 results, especially the booking trends and margins, to see if that coordination is truly delivering or if the pressure for a breakup intensifies.
Absolutely. The next couple of quarters will be critical.
Thank you for joining us for this deep dive.